Welcome to the Forager 2021 Investor Roadshow. I'm Nadine Blaney from AusBiz, and I'll be your host for today's event.
Thanks, Nadine, and welcome everyone. Sorry we couldn't get around to see you in person this year. There are some important attributes that we think are foundational to any edge we have in investing. We have the freedom to invest in stocks regardless of their market capitalization, sector, or where they are in the world. We have an approach that always puts valuation first without restricting ourselves to value stocks, low PE stocks, or dividend payers. And we have the ability to run a concentrated portfolio of best ideas, while being acutely aware of the benefits of diversification by size, sector, and geography. So this kind of flexibility is always where we're looking for an edge. But wow, did this flexibility pay off in 2021?
Yes, that's right. It was a year where being different and where being flexible definitely worked. The market was moving with such ferocity throughout the last 18 months, both to the downside and the upside, that the optimal strategy was not just to place your bets in March and let them roll forward, but constantly refresh and update the portfolio, particularly when the market was giving you new ideas and new opportunities all the time. We worked as fast as we could without sacrificing any quality of research to try to take advantage of these movements. It worked really well for us over the past 12 months, but of course, we ended up missing opportunities that we wish we could have bought and owned since that period.
Yes, you'd think we wouldn't have much to complain about after such a successful year, but the process itself has actually been quite frustrating. I've lost count of the number of times we'd bring up an idea and then the share price would almost immediately run 20 or 30%. So for every new idea that you've seen in the portfolio, there were a bunch that we started working on or even nearly finished working on and we missed because they just move so quickly.
Yeah, indeed, it's frustrating. But it's important to keep in mind that investment records are put together by what you own, not what you don't own. And I'm not all that convinced that if we had got 2 or 3 times as many ideas into the portfolio, we would have done better. Learn and adapt. Look, as we touched on, moving with speed has been the really important factor this year. Shifting focus was the key. Sitting still was not the optimal investment process. The first 6 months coming out of the pandemic low in March 2020, it was really, the easy wins were really in quality stocks.
Yeah, that's right. And by the time November came around and the US election, and more importantly, the vaccine news, you had a whole different type of segment of the market that started to perform. The airlines, the travel stocks, some of the beaten up cyclicals, they all had their day in the sun through the back end of the year. Fierce moves upwards, 50 to 100% moves in a very short span of time. The back half of the year was a bit different. It was much more choppy when it came to what type of factors worked in the market. It was more about idiosyncratic ideas and bottoms up stock picking than placing your bets on either side of the reopening trade.
Let's now talk about some of the fund's most important contributors over 2021. It was a very lopsided year. We had some big winners. We'll get to some of those in a moment. But perhaps more importantly, there was this really long tail of meaningful contributors, more than 24 meaningful contributors to the portfolio and no large detractors. So, of course, the bull market was crucial here. I don't want to downplay the significance of that tailwind to the year we've just had. But there are some themes that worked very well for us. And so let's highlight some of those. Probably the first one to talk about is stocks going through SPACs, IPOs, and big raising. So we're talking about companies raising money in one form or another in the market. There were 7 meaningful contributors there, really, really important to the fund's returns, and they would have been materially poorer without those returns. What I think the team can be really proud of here is that we identified this as a severely underfished pond at the start of the year, and we resourced appropriately, and it's paid off meaningfully. Harvey, you deserve most of the credit for this.
Thanks. Yes, it's true. SPACs, we've said this many times in the past, they can be a minefield. We completely understand that a big portion of the investing community just doesn't bother looking at the space. A lot of the companies are coming to the market with limited revenues, no real track record, and there's many question marks regarding what the future looks like for them. Our approach has been to turn over a number of rocks. We've looked at dozens and dozens of companies, and we invested very, very selectively. From the few investments we did make, we've been very fortunate. We picked high quality companies with solid historical track records, and most of them have gone up quite significantly since we put in the portfolio. We think it's an underfished pond even now, but you do have to be careful. We remain positive on the ones we still hold.
Another important group for us was quality compounders, some that we've owned for a few years now and others that we had the opportunity to add during the crisis. These compounders are usually larger businesses, and we think of them like a portfolio base. So we always want to have a chunk of the portfolio in these kinds of businesses, as they improve the risk return profile of the portfolio over time. This year, Zebra and CDW were among the contributors in this bucket. And another stock that I think was an undiscovered quality compounder is Farfetch.
Oh, I think this one's a great example of understanding your investment edge. Can you outline the investment case as you saw it before we bought the stock?
Yes. So Farfetch is the global platform for the luxury industry. Our most successful investments tend to start with what we think the market got wrong. For this, you need to have a variant perception. And as a female, you can have a bit of an advantage here in certain types of stocks. There are a bunch of stocks out there that you might know really well from a consumer perspective that most other analysts just don't. And this Farfetch was a really good example of this. When we started looking at it last year, it was valued at around $6 billion US. At that price, there had to be some big question marks around whether this was going to be the dominant platform in the industry. And that's fair enough, because from afar, it looked like just another online luxury retailer with no real competitive advantage and the threat of Amazon lurking around every corner. But I had the view that not only does Farfetch add value to the luxury brand that it works with, but it also adds value to the industry as a whole. So for that reason, I was confident that it would end up as the dominant platform. And if it did, $6 billion is a really low valuation for this business. You can see on the chart that revenue estimates for 2021 have increased pretty significantly since our purchase in mid last year, as people started getting more comfortable with the Farfetch business model. It basically shows my thesis on one page. Analysts and the market as a whole were just really underestimating how much consumers would buy from the Farfetch website. We sold out around the highs early this year, so it was a really short holding period for us, but it contributed significantly to returns for the year.
I think it's fair to say that Farfetch would never have been in my circle of competence. Last time I bought a handbag for my wife, I let my 5-year-old daughter pick it. Recovery stocks is an area I know a bit about. That's the third area I'd like to highlight. They added meaningfully for us this year, especially around that second quarter as the vaccines emerged and their efficacy came to light. No one recovery play sits right at the top of the list of contributors, but 8 of them together work very well to add meaningfully to move the needle. I think it's really worth remembering here how myopic the market can get at the period of peak panic, particularly with these sort of cyclical stocks.
That's right. Linamar, I think, is a great example of that.
Yeah, Linamar is a manufacturer of precision equipment, chiefly for the automotive sector. And it's one of those businesses the market can get very wrong at times. Yes, it's cyclical, but it's also a structural grower. And when a left field event like COVID comes along, all investors see is that cyclicality and they dump the stock. Don't get me wrong, I don't think we played this one particularly well, but it was evident and obvious that it would recover, and we've benefited from that. This business has been unprofitable just 1 year in its 35-year listed history, which is pretty impressive for a so-called cyclical stock. That was in 2009. 2020, they actually had to shut plants for months on end, and they had one unprofitable quarter and were decently profitable for the full year. Look, the global shortage of computer chips is having an impact here on the whole automotive sector globally. It is definitely capping what would have been more explosive growth recently. I think the effect of that is to just elongate the good part of the cycle. Linamar remains one of our top 10 positions, which should tell you everything you need to know about my thoughts on value and outlook. The other thing I wanted to add was the transition to electric vehicles, which has long been viewed as a risk for this business. In the last quarter, more than a third of new business wins were on electrified vehicles. So I think they're making that transition beautifully. So again, this is an example of the sort of stock that the market gets really, really wrong in a panic, and I think they're actually still underestimating this one. So that's the recovery stocks. It would be remiss of us not to mention some of our hard to bucket idiosyncratic ideas, particularly those towards the top of the list, and most importantly, Celsius.
Yes, well, ultimately, it's all about finding those great individual stock ideas that really make a difference. Our top performer for the year, and perhaps one of the most successful investments throughout the fund's history, was Celsius, the energy drinks company. It's a great example of riding your winners and not selling too soon. But it's also a great example, and we'll get to it, about recycling into ideas, even once you sold out and the market gives you another exciting opportunity. So what is Celsius? A few of you may already be familiar with the name, but it's essentially an energy drinks company that's disrupting a market with very high margins that has been dominated by a few key players. We first looked at this business at the start of 2020, and we saw a company that's growing top line at the 30-40% level, but trading at discounted values. We couldn't really understand it, so we did the work. Obviously, we got pretty comfortable that this was going to continue. We saw that from the industry data that Celsius was taking share, and that the feedback from customers was extremely positive. We thought it was a great opportunity, and we bought it in February of last year, just before COVID hit. We added at the lows as well. So all of this has actually came into fruition. The company doubled their sales over the past year. It's been a significant contributor to the year.
Clearly great stock picking there, Harvey. And if someone had just bought this at the same time that we first bought it and held it, they'd have done very, very well. I think you've also had a lot of value here in terms of the trading around the ebbs and flows in the stock.
Yeah, we've seen that across our portfolio over this year. It's been a volatile one, and the market's giving us opportunities on both sides of the equation. We originally bought this stock back when it was trading at $5 at the start of last year. It had a great run. As of February of this year, it was trading around the $60, $70 range. And we thought that it had maybe run ahead of itself, along with many parts of the market that are the faster growing segment. So we sold a position, and subsequently between March and May, a lot of these stocks sold off quite heavily and derated. All of a sudden, it was back to trading in the 40s. At the same time as this was happening, we track industry data, and we saw that their sales growth was accelerating significantly. It was stepping up from 100% year-on-year growth to 200% year-on-year growth. And we felt the market was perhaps missing this. We bought the position again, and thankfully it's made us a good amount of money the second time around. We still hold the position at this point.
So let's now move on to our best prospects for the current year. Any important themes, team?
Well, yes, especially in July, we saw small caps sell off significantly in the US. You saw the bellwethers, the FANG names, the S&P 500 hit new highs every single day of this month. But a lot of the smaller names had serious moves down. So as they started underperforming, we actually used that opportunity to top up some of our favorite names that we either already own or pick some new positions. And we just talked about how we did that with Celsius over the past couple of weeks. The pullback means that our portfolio has a lot more upside now than it did a few weeks ago. So this is something that we have always tried to do, and we will continue to do. Focus on areas of the market that are beaten down or temporarily ignored for whatever reason. We've talked about SPACs presenting a good opportunity, but there's a lot of spin-offs that are coming to market recently, and there's a lot of new raisings and IPOs. These sometimes are very well received and the stocks trade up significantly, and sometimes they're forgotten for a period of 3 to 6 months. It is within that period that we try to take advantage of the opportunity if it's a name that we like, because the market is focused and looking elsewhere. So, Chloe, what about yourself?
Another type of idea that we're always interested in is long-term growers, especially when they're misunderstood and mispriced. UK-based online retailer Boohoo is a great example of a business that's going really well and a share price that's not reflecting that. It's hard to deny the strength of the Boohoo business model. Its sales have increased more than 50% per annum over the past 10 years, and that whole time it's been both profitable and cash generative. However, the company has had some ESG issues over the past 12 months, which is what presented the opportunity to us. While management have taken a number of steps in the right direction to rectify these issues, the stock is simply uninvestable for a chunk of the market. While it may not ever be a darling stock, if the business keeps growing like this, the valuation gap will have to close at some point. And we've got a number of other examples of this in the portfolio. What are you most excited about, Gareth?
I think some of those recovery stocks, some of the cyclicals, particularly the higher quality ones, I think they have a long way to run still. We have this weird all or nothing sort of market. Back in February and March, the US bond yield started its move from 1.5% to 2.5%. And all anyone could talk about was inflation. Then the Delta strain comes along, cyclicals get punished, bond yields fall again. I think it's important we just look past the noise. We've talked about Linamar already. Motorpoint, the car dealer in the UK, I think it belongs in the same group. We own online travel retailer lastminute.com, which is heavily exposed to a recovery in leisure travel in Europe. And we also own the airport in Vienna, which is linked to some of the same themes. Look, there's no doubt this Delta strain has upset part of the thesis. It's given everyone pause for concern. But I think there's a massive catch-up period here of holidaying and partying and getting back to normal. I remain very much long-headedism. I think that there's some very good signs coming out in the UK, in particular, that they are emerging through this Delta strain. And I think these businesses that I've mentioned, I think it's very likely that in 12 months' time, they'll be facing significantly better business conditions than they do today. If I'm wrong, and it takes 24 months or 36 months, they've got the balance sheets to survive until they can prosper. Look, one way or another, I think life's getting back to normal, and we're all going to have a lot of catch up to do. And I want to own some names that are really linked to that.
100%. One area that I'm personally digging into is ad tech, advertising technology, that is. I won't talk any names yet, but you should keep her out for our upcoming monthly and quarterly reports, as we're definitely going to be talking about this stock that we put in the portfolio recently. It's an exciting industry at the moment. Digital video advertising continues to grow, and connected televisions are becoming more common in households. This allows advertisers to target the right kind of person for the right kind of ad, leading to higher returns on investment for someone who wants to place an ad in front of an eyeball. We love this business, and we're excited about the prospects that it holds. Now, it just goes to show that even though the markets are sitting at all-time highs and much higher than they were 12 months ago, the environment is constantly shifting. Technology is constantly evolving. There is always something that has a lot of pent-up upside the market is forgetting about or just starting to realize and find out about. So we're very excited about the new positions we put in the portfolio and the prospects for returns over the coming 12 months.
Thanks, Harvey. Thanks, Chloe. Look, 2021 was a year like none we've ever experienced. It's unlikely to be repeated anytime soon. But the process that led to that very good year, the flexibility, the speed, the ability to go where others are unable to go, they will have payoffs in the years ahead. Thank you very much for your time, everyone. And I really hope we get to see you in person next year and have a laugh about all this. Back to you, Nadine.